Hello and welcome, everybody. Today is Wednesday, February 28th. I'm Jeff Hughes, Chief Investment Officer at JWH Investment Partners and the founder of Alpha Insights. And this is your Daily Five. As most of you will know, the Daily Five is the show where we go through our top five charts that are top of mind this week. We actually have a couple bonus charts, so stick around to see the end. Before we begin, I just want to give a quick heads up that we will be publishing the next issue of Huge Insights, The Big Picture, on Saturday, March 2nd. That's this coming Saturday for those of you who are not familiar with our investment newsletter. This is a publication that comes out every the first Saturday of every month. And of course, it's free to subscribe to the newsletter via Substack. You can find it at hugeinsights.substack.com. Have it delivered directly to your inbox. Typically, we do publish following the monthly NFP report. We've entitled the newsletter affectionately Huge Insights, The Big Picture, because in this newsletter, we try and address a number of key macro factors that are affecting both the economy and the markets. And, a lot of people who read our work, they like the ideas, they're looking for a way to put this to work. And we get a lot of inquiries. Hey, Jeff, how can we take your insights and put this to work in our portfolio? And so, for those who want a little bit more, we also have an option to upgrade to paid for as little as $12.50 a month. This actually includes a much deeper, more granular look at our market forecast and our positioning recommendations, in addition to some additional content that wouldn't normally be available in the free portion of the newsletter. Paid subscribers also receive our weekly Alpha Insights Idea Generator Lab publication. This is part of our institutional package that we make available to newsletter subscribers as well. It actually details our top actionable trade idea each week and provides an updated look at some market commentary. And that goes out every Wednesday afternoon. And in addition to that, we do also provide access periodically to interim bulletins that we publish when we've got something to say in between our regularly scheduled publications, and some special video content as well. So there's a lot there for $12.50 a month for those who are interested in a little bit more. Let's get started. Chart number one takes a look at the advanced decline line and notes the divergence that has developed here. This chart is actually taking a look at the NYSE Composite Index on the top frame. This is a broad market proxy. It contains some 2,200 issues. It includes a vast array of both primary and secondary stocks, closed-end funds, preferred stocks, and also about 400 ADRs. The index actually posted a new all-time high on February 23rd, along with the major averages. And, the only thing that really has caught our eye here is that despite that fact, the advanced decline line for NYSE common stocks only actually made its high back on February 15th and has failed to confirm the new high in price in the index. Now, famously, when this pretty well-known breadth indicator fails to confirm price action in the broad market, it has historically preceded important market trend reversals. And that's something that we are concerned about right now, and we'll dig a little deeper into that as we go through the deck. But I also wanted to point out, also importantly, there is a double negative divergence now developing in the ratio of new 52-week highs to new 52-week lows. That's the bottom frame here. And as you can see, that topped in, I think, January, or actually late January, then again around the 15th of February, and now we're making another lower high. So that's a double negative divergence there. Here with the NYSE Advanced Decline Line common stocks only, we've got a lower high as well. That negative divergence is not confirming the new highs in price. And this is a concern because, of course, these sorts of negative divergences tend to be a warning signal. Let's move on to chart number two. Chart number two is a study, and this was conducted by Yardeni Research a number of years ago. It actually takes a look at data from 1980 through 2016. And we've entitled the chart, "The Consensus Forecast is Wrong." Why do we say that? Well, the chart illustrates the percentage change in the Wall Street consensus annual forecast for S&P op EPS. And really what it's doing, it's looking at the initial forecast to the actual result. It's about a 25-month period of time. And it looks at a 36-year period from 1980 through 2016. The reason that we say the consensus forecast is wrong is because 100% of the time, the study shows that the top-down consensus forecast has been wrong, okay? Looking back over that 36 years. Now, the consensus actually overestimated S&P operating earnings 78% of the time, and by an average of greater than 19%. And so, the consensus is really been a very, very optimistic cohort, if you will. Now, they have also underestimated S&P operating earnings periodically, but only about 22% of the time, and only by an average of just 6.7%. And so, according to S&P Global, which is our data source for the current consensus S&P op estimate, the street is looking for 2024 and 2025 S&P operating earnings of 240 and 272. Well, based on the history that this group of forecasters, which is dozens of Wall Street economists and strategists, and just using history as our guide, the actual results could just as likely prove to be $194 this year and $220 for next year. Now, that's very much in line kind of with what we're thinking for this year. We've actually got a published estimate of 187. And so if the consensus estimate is wrong by 19% and overestimating, we could easily see 194 and perhaps even worse. The interesting thing is that earnings have been basically flat for the past 3 years. 2021, 2022, and 2023 have all come in kind of in this 218 to 220 range, effectively no growth for that period of time. And if in fact these consensus forecasts are overly optimistic, as they typically have been in the past, then it's quite possible we could see 5 consecutive years of flat earnings. We'll have to see. Stay tuned on that one. But I just want to kind of give you a sense of what this process is like over time. Let's look at chart number 3. 27.9 times. What is the forward 12-month PE, Alex? Taking a little bit of a tilt toward Jeopardy here, or tipping our hat toward Jeopardy. A lot of people would look at this number and go, "What are you talking about, Jeff? I haven't heard anybody on financial, television talking about a 27.9 PE for the market." Well, let's just take a look at what we have here. The S&P 500, in our view, is excessively valued right now. And excessive valuation is not a catalyst by any means, but it is a warning. And what it means is that in aggregate, investor sentiment is what's been driving the price of stocks higher, not the fundamental earnings growth of the companies that make up the stock market. So, based upon consensus bottom-up estimates for calendar year 2024, in other words, the next 12 months, and using data that we've acquired from LSEG Data and Analytics. This is what used to be Refinitiv, and this data is through last Friday's close, February 23rd. We actually updated a study of the forward 12-month price earnings multiple that we've done for the top 100 stocks in the S&P 500. Why the top 100 stocks? Well, they collectively account for 71.8% of the market cap of the benchmark index. So, that is a large proportion of the market cap of the benchmark, really concentrated in just 100 stocks. And, I don't know the exact number, but it's well over 50% of the earnings for the S&P 500 are derived from those top 100 stocks. I've actually read At one point in time, it was upwards of 83% of S&P operating earnings came from that cohort of stocks. But that's a moving target. We never know exactly how much it changes quarter to quarter, but something well above 50%. So this is a group of stocks that we must pay attention to. And what the study concludes is that the largest and most influential 100 stocks in the US equity market are currently trading at an index-weighted forward 12-month price earnings multiple of 27.9 times. Now, that is a high valuation. The valuation multiple actually exceeds that which attended the peak of the dot-com bubble back in March of 2000, when the S&P 500 traded at an index-weighted forward PE multiple of just about 25 times, based on the then prevailing bottom-up consensus forward 12-month earnings estimates at the time. But as all will know, those estimates turned out to be completely unfounded. And those earnings never came to fruition in the year 2000, and the stock market ultimately lost roughly 50% of its value over the subsequent 2.5 years. We have a detailed Excel spreadsheet that goes into the granularity of how we arrive at this number, and subscribers to our newsletter will be able to access this data in the newsletter on Saturday. So if you're not a subscriber, sign up and you'll be able to take a deeper look at that as well. Chart number 4, there's been a lot of discussion about the Mag 7, the Magnificent Seven. This is a cohort of AI stocks, these institutional darlings, if you will. It includes Microsoft and Apple, NVIDIA, Google, Amazon, Meta, and Tesla. Although, a few of these names are kind of losing their luster. Tesla's down some 20% year to date. Apple was down as much as 5% on Friday when we ran the numbers. And if I'm not mistaken, Google was even down 1% or so. And Microsoft is just barely positive. NVIDIA has been the big winner this year, up 60+%. Meta right behind it, around 35 or so. Amazon's not been bad. I think up around 13 or 14 or 15% last time I looked. And so, these have kind of been the drivers of performance this year. But, the prospect of a new paradigm driven by artificial intelligence has really captivated the minds of investors. And, it's led to a level of market concentration in these mega cap tech stocks that really rivals that of the dot-com bubble era, or even the Nifty 50 back in the 1970s. And that's why we entitled this slide, The Mag 7 versus the World. And what we've done is we've kind of highlighted here with this red circle, these are the US 7 stocks that we're talking about here. And according to this research, which was compiled by Deutsche Bank, the combined market cap of the so-called Magnificent Seven exceeds that of the second largest stock market in the world, China. So here's the US stock market. Here's the China stock market, the second largest in the world. And the Mag 7 are actually larger by a significant margin, okay? And it's actually double the size of the third market. We're 13.1% of total world market cap. Japan is 6.2%. That's the third largest market in the world. So, one of these stocks, in fact, Microsoft, which is the largest company in the world, or in the U.S. right now, and that stock alone is now larger than 75% of the G20 country stocks. And so, I think the real point here is that the overconcentration of the market in these stocks is really, frankly, unprecedented, the extent to which they dominate. And one could argue that the profits of these companies now exceed, a wide swath of global stock markets, right? The profits are highly concentrated as well. But much of that profit comes from advertising dollars. And advertising dollars is a highly cyclical business. And we believe that if we do see an economic downturn in 2024, which is our forecast, we could see much of that advertising revenue come under pressure. And that would immediately attack that profitability factor that the Mag 7 has so proudly worn for some time now. So another concern to just kind of keep in mind as we take a look at what the markets are up to in the next few slides here. Slide number 5, I just want to hit again investor sentiment. Now, we've been talking about investor sentiment for some time. We started to get some pretty incredible readings in December, and we've been highlighting those in these presentations and others that we've been making publicly, as well as in our newsletters and institutional research service. But the point here is that sentiment has again hit another bullish extreme. For the second time this month, the Investors Intelligence Survey of Advisors saw a new bullish extreme. Now, net bullish advisors, this is the bulls divided by the bulls plus the bears, came in at 77.5%, right up here, okay? That's the dark black line is the survey line. And so we can see that, it is now exceeding the July highs by a pretty wide margin. And recall that, back in July, we topped here in the S&P 500 with that high level of bullishness by advisors. And that preceded an 11% decline over the subsequent 3 months in the S&P 500. If we were to set the Wayback Machine to say December of 2021, it's not shown in this chart, but actually this level now exceeds that level that preceded a 27% decline in the S&P over the subsequent 9 months from January 2022 through October of 2022. And so it's quite concerning, to be fair. Now, the Investors Intelligence Survey really just complements the results that we've been discussing over these past several weeks and months. The surveys that we've talked about include the Name Exposure Index. This is an index of professional investors that basically indicate the extent to which they are net long equities, and that has really been hovering up in the 90s%. It got as high as 102% in late December, and has come down and actually made a lower high. So we're seeing a negative divergence there. The Fear and Greed Index, the CNN Fear and Greed Index, we've talked about quite a bit as well. That's been hovering in extreme greed territory off and on for the last 2 months here, since late December through late February. I think yesterday it closed out at 78%. It topped in late December, I think December 26th, at 80%. It has yet to make a new high. So again, slightly diverging negatively, even as the major averages make new highs. And then also, we've been talking about another survey, Consensus Inc., which posted its highest level really since the bear market began in January of 2022 recently. And so, that's just to name a few. There are many others. The VIX is a fear gauge as well, and that shows a lot of complacency, hovering down in the low to mid teens recently. And so, the real issue here is that these recent bullish extremes exhibited by all of these surveys kind of represent a stark contrast when we consider it in the context of the record insider selling that we've seen this year. Most recently, Jeff Bezos, Jamie Dimon, and Mark Zuckerberg sold $9 billion worth of stock. These are 3 guys that rarely ever sell stock. It's been years since Jamie Dimon has sold stock. And for him to sell stock is potentially an indication that maybe he doesn't think the market's got much higher to go. Maybe Zuckerberg, Bezos, who knows the reasons that they're selling stock. Maybe Bezos wants to launch another rocket into space. Maybe Zuckerberg, has a new project that he wants to work on. We don't know the reasons. There's lots of reasons that these guys sell. But, there's only one reason that they buy, and that's that they think the stock's going higher. And I don't see a lot of insider buying right now. In fact, the insider sell-buy transaction ratio hit an all-time record extreme earlier this year at 145 to 1. That was in late January, and that was kind of a shocking figure. I think we talked about it in one of our presentations recently. So let's jump to our first bonus chart here. Bonus chart number 1 really takes a look at the S&P 500 and our Elliott wave count dating back to October 13th of 2022. where we started. We labeled this primary wave 4. That's a primary wave 4 low. So this entire channel here is primary wave 5. And we've counted it at, kind of an exhaustive level. We've got, 1, 2, 3, 4, 5. That's intermediate wave 1. We can count 5 waves up. We get intermediate wave 1 that topped on December 13th. Then it was followed by an ABC flat corrective waveform to get intermediate wave 2. That bottomed on actually March 13th last year. We got a very torrid rally here into July. All will remember we got a big breakout, I think, right around here when NVIDIA first told us about their new AI chip and how great things were going. But, all we were able to do is count 1, 2, 3, 4, 5 waves up to complete intermediate wave 3 on July 27th. And that was followed by an ABC zigzag corrective waveform to end intermediate wave 4 on October 27th. Since that time, we've seen kind of this exhaustive move here. This first initial foray here we thought was topping here, but we were wrong. That was just minor wave 1 up. The pullback counts best as minor wave 2. We get another 5 wave move to the upside here, and that counts best as minor wave 3. And what's happening here is we're now testing this trend line. This trend line is the trend line that connects primary wave 4 to intermediate wave 4, and then we take the parallel of that trend line and attach it to the intermediate wave 3 high on July 27th, and that's where this comes from. And what we've seen is we've penetrated that and then moved back below it in 3 waves, A, B, C. We're counting this as minor wave 4, which means that this most recent move up is very likely minor wave 5 to complete intermediate wave 5, which would then complete primary wave 5, cycle wave 5, and by extension, if we're correct, super cycle wave 3. We believe that the market may have topped at S&P 5111 on February 23rd. That was last Thursday's intraday high. Now, we've seen a little bit of a pullback, but not enough to give us confidence in that count. One thing that does give us confidence is this dramatic, fading in breadth, okay? What we're looking at here is the S&P 500 issues that are trading above their 50-day moving average. And that actually peaked in early January. And from that early January high, we've seen nothing but lower highs emerge as the market has pushed to its new all-time highs. This negative divergence in breadth kind of confirms the negative divergence in the NYSE common stocks only A-D line that we talked about at the outset of this discussion, and gives us a lot of reason to believe that the market is really just running on fumes at this point. Let's take a look at bonus chart number 2. What we've done here is we're just really going to take a look. We're going to magnify this last move up, this minor wave, or I should say intermediate wave 5. And we're going to take a look at the subdivisions of that a little bit more closely. So starting from that October 27th low here, we count 1, 2, 3, 4, 5 to complete minor wave 1 up, minor wave 2 down, 1, 2, 3, 4, 5. And we saw some subdividing here, a 1, 2, 3, 4, 5 as well to complete minor wave 3. Now we think this is an ABC to complete minor wave 4, and this push up could be minor wave 5 to end the entire series, right? To top the market at 5 degrees of trend, at least 5 degrees of trend. Now, where we could be wrong is that it's possible minor wave 4 ended here, okay? And if minor wave 4 ended here as per the alternate count line, then this is probably minute wave 1. This is probably minute wave 2. This would be minute wave 3, minute wave 4. And we have one more push higher to complete minute wave 5. And that would then end minor wave 5, intermediate wave 5, primary wave 5, cycle wave 5, and by extension, super cycle wave 3 if our count's correct. Again, we show a serious momentum divergence from the beginning of this rally to where we topped most recently. And of course, as the market's pushed up even further, momentum's really kind of flagged here. And so, at the end of the day, we think the best way to consider where we are in the market is one of these two counts. We either topped Thursday at S&P 5111, or we're going to top with one more push higher. Now, what could cause that? Well, there's some additional economic data coming out this week. We will get the PCE data. The core PCE number is expected to be a little hotter than it has been in recent months. That'll be reported tomorrow morning. Let's say we get a little bit better showing from the PCE. That could be what it takes to push things up and to top in kind of what I would call the final kind of throw over. And what we're really looking for, I guess, to determine whether or not we've actually topped is we want to see if we push to a little bit higher high, a breakdown below about 49.20. Okay, this prior low right over here. And if we could take that out on a daily closing basis sustainably, right? And even from current levels, we may get a worse number tomorrow from the PCE, and it just accelerates things lower, right? We'll have to wait and see, but a break below 49.20 would be the initial evidence to suggest that top is in. It takes this little throw over here that we've been talking about and brings us back into the channel. And finally, we've marked all of these open chart gaps. Okay, so they begin at 49.81, 49.07, 48.02. We think once we break 49.20, these should start to fall like dominoes. We'll start to see the market close all of these open chart gaps all the way down here to 35.83, the open chart gap that dates all the way back to October 13th. Our view is that this top is going to prove to be a durable top, and that the market should begin what we believe will be a multi-year, if not decade-long, super cycle degree corrective waveform. Which should coincide with, a U.S. recession and global recession and a potential financial crisis. And we're going to talk about where we think that financial crisis is emanating from in the newsletter. One of the areas that we think will be a clear driver of it is the lack of liquidity. And a lot of people look at the Chicago Fed's financial conditions index to determine the level of stress in the financial system. But we've found a couple of cracks that are starting to develop, and we think liquidity is about a mile wide and an inch deep right now. And we think that could be what really is the problem for equity markets going forward. So with that, I would like to just offer up my contact information. If anybody wants to follow up, you can always check out our website at www.jwhinvestment.com. Send us a note if you like. You can also follow us on Twitter at alpha_insights. And of course, check out our newsletter on Substack. It's hugeinsights.substack.com. Thanks a lot for watching today, and best of luck trading.